Hello and welcome to this podcast. This is the second of two podcasts in which we examine the time apportioned base cost formula in the 8th schedule of the Income Tax Act. In part 1, we examined the simple time apportioned base cost formula, and in part 2, we're going to have a look at the modified time apportioned base cost formula. Now, from our first example, in the first podcast, hopefully you remember these figures. We bought a house for 20 Rand and we sold it for 100 Rand, and we apportioned the gain of 80 Rand partly to the period before October 2001 and partly to the period after October 2001. We added the portion of the gain before October 2001 to the base cost, increasing it from 20 Rand to 60 Rand, and that resulted in a part of the overall gain being excluded from capital gains tax. Now, this formula is based on the assumption that the increase in value of the asset occurred evenly over the period that it was held. But what if we know that that's not true? What if we know that we incurred expenditure after October 2001 that would not have been factored into the selling price if we had sold that asset on or before the 1st of October 2001? Well, that's where the modified base cost formula comes into account. So let's work with our same example. Let's start with a two-story house, but this time let's say that we built a third story onto the house after the 1st of October 2001. Let's say we built it on the 2nd of October 2001. So if we'd sold the asset on the 1st of October, we would have sold a two-story house. But if we'd sold it on the 2nd of October, we would have sold a three-story house, which presumably would sell for more. Well, up to the 1st of October 2001, we had a two-story house, as in the previous podcast. So if we'd sold it on the 1st of October 2001, we would have expected to make a gain of 40 Rand. Unfortunately, we only know that because of the figures that we've carried over from example 1. In actual fact, we couldn't know that now because we don't know what a two-story house would have sold for. All we know is that we sold a three-story house. Let's say that we could sell that three-story house for 150 Rand. That makes sense. In example 1, we sold a two-story house for 100 Rand, and this time we're selling a three-story house for 150 Rand. And let's say that the third story cost us 10 Rand to build. Again, the first two stories cost us the initial purchase price of 20, so it makes sense to say that the third story cost 10 Rand. But that's just for the purposes of the example. Overall, we've made a gain now of 120 Rand, being the 150 Rand selling price, minus the initial purchase price of 20, and minus the improvements of 10. However, we can no longer say that that gain has grown equally over the 8 years that we've owned the asset. Up to the 1st of October 2001, we only had a two-story house. And we know from the first example that that would have sold for 60 Rand on the 1st of October 2001. So all of the rest of the gain of 80 must relate to the period after October 2001. And that 80 is the part that should be subject to capital gains tax. So with simple numbers we've been able to see what that should be, but can we get to a formula that works this out? Well, what is sitting in that gain of 80? It's the original 40 Rand from the first example that would have happened even if we'd sold a two-story house, and it's another 40 Rand. And that other 40 Rand must relate to the third story that we added to the property at a later stage. And if you do the maths, that makes sense. We were going to sell it for 100 Rand, we've now sold it for 150 Rand, and it cost us 10 Rand to make those improvements. So that gain of 40 Rand relates to the third story. So what should be subject to CGT? Well, all of the 40 Rand that relates to the improvement should be subject to CGT because that improvement was made after October 2001. And half of the 80 Rand that would have happened even if we'd had a two-story house should be subject to CGT because half arose before October 2001 and half arose after October 2001. What would the proceeds have been if we had sold a two-story house instead of a three-story house? Well, we know from example 1 in the previous podcast that it would have been 100 Rand. But could we get back to the 100 Rand using the numbers that we've got in this example? Well, If we sold a 3-story house that sold for 150 Rand, it makes sense that each story is selling for 50 Rand. So a 2-story house would have sold for 100 Rand. How could we get to that 100 Rand? Well, we would take the 150 Rand that we actually sold the house for and multiply it by the expenditure that was incurred before October 2001 as a proportion of all the expenditure that's incurred. The 20 Rand initial purchase price divided by the 20 Rand plus the 10 Rand improvement. So if we hadn't made those improvements, the house would have sold for 100 Rand. If we express that as a formula, what we're saying is the selling price of 150 Rand, call that R, multiplied by the expenditure before October 2001, divided by all the expenditure incurred, equals P, our modified proceeds. That's what we could have sold the house for if we had made no further improvements after October 2001. Now hopefully that formula looks familiar. That is the modified proceeds formula, and that's the input for the modified base cost formula. So what is the value of the asset as at the 1st of October 2001? Remember that that is the 2-story house, because those improvements haven't been made yet. Well, we remember from the first podcast that the value is 60 Rand, but how do we get to that 60 Rand? Well, it's the initial purchase price of 20 Rand plus P, which is now the amount that we got from the previous calculation here of 100 Rand, minus the 20 Rand original expenditure, multiplied by 4/8, 4 years before October 2001, as a proportion of the total period that we've owned this asset, which gives us 20 Rand plus half of 80 Rand, which is 20 Rand plus 40 Rand, which is 60 Rand. That's what we would have been able to sell this asset for if we'd sold it on the 1st of October 2001, and if we'd sold it in the condition that it was then, before we had made the improvements. So what is our capital gain if we use that as our base cost? Well, it's the proceeds of 150 Rand minus the 60 Rand that we've just calculated, plus all of the 10 Rand incurred on the improvements, because those were expenditure actually incurred to earn those proceeds, so it should be added to the base cost. Gives us a total base cost of 70 Rand, and that is a capital gain of 80 Rand. That's that same 80 Rand in green. 40 Rand that would have arisen out of the 2-story house, plus the 40 Rand that arose out of the 3rd story that was added. So there you go, it's half the original 80 that would have arisen out of the 2-story house, plus all of the 40 that relates to the 3rd story that was added to the property. So that's how the modified time apportioned base cost formula works. The theory is the same as the simple time apportioned base cost formula, but now it accounts for the fact that we've incurred subsequent expenditure after the 1st of October 2001 that has given rise to an increase in the selling price. And that increase would not have occurred if we'd sold the property as at the 1st of October 2001. So I hope that's been helpful, and if there's anything I can help you with, please feel free to email me. Thanks for watching.